everybody's doing fine on this sunny March 27th. I wanted to kind of continue our conversation from last month on these annuity products and how they actually can be either beneficial for you or possibly some of the things that you need to look for in these types of products, and why you might want to add them to your portfolio or why you might not want to add them to your portfolio. So I'll do a quick recap on some of that before we get too far into it. And then I'm going to try to talk about the top misconceptions that I see when people come in. Either they've already purchased an annuity and they think it'll do something that it probably won't, or they are thinking about it and they have another misconception about it, or maybe they don't want to buy them because they feel like that they are somehow trapped in them, or would lose their money if they started taking income out of them, or those types of things. So I'll talk a little bit about all that. We should probably wrap up in about 20-25 minutes or so, maybe even a little bit shorter than that. Wanted to kind of give you an update on a couple of events that's coming up. First of all, if you haven't logged in and seen our previous webinars that we've done, feel free to go back to mwawebinar.com. You can go in there and view the various different webinars that I've done. And especially if this is the first one you've logged into, you obviously want to go back and review part 1 of these Annuities 101. So you kind of get a flavor for what these products actually are. Also, a couple of dates coming up in April. On April 16th and 18th, we're going to be doing a dinner presentation over at Ruth Chris Steakhouse here in Louisville. If you're local and you want to come to that come to that presentation, go to mercurioadvisors.com. You can register there for that event. You're going to have to do that pretty quickly. Those events fill up really quick. And obviously you're getting a nice steak dinner. And what we're going to do in those types of presentations is we simply just talk about our process, how we help our clients, how we had developed this process over many, many years. And then also on April 15th and 22nd at the University of Louisville University of Louisville Shelby campus, right across the street from our office, Troy Bolton will be doing presentations on retirement income planning. So what we're doing and what he's been doing over the last several months is we've done a tax class, we've done a Social Security class. Now we're going to kind of go into the income planning class, and we'll continue building those classes out. So you can go in there. It's not a dinner seminar. You're actually going into a classroom. Usually lasts about an hour and a half or so, but you're actually getting a good understanding of what's going on in planning and how you actually can build your retirement plan for that. So those are some upcoming events that you can take a look at if you'd like to join us on those. We got a lot of participants on already, so I'm going to go ahead and get started and kind of do a recap of what the annuities are to start with. So this is basically what we're calling Annuities 101 Part 2. And of course, there's always the disclaimer in there that I just kind of skipped past real quick. But the disclaimer is obviously you want to do your homework on these types of products. You want to make sure that you're understanding exactly what you're getting and how it's going to work and how it's actually going to benefit you in your present or in your portfolio, your retirement plan. Not everybody needs one of these, but it is a nice way, especially with interest rates as low as they are. It's a nice way to kind of get a bond replacement or some kind of investment that's protected. I call it putting a fence around your money, making sure that you're not going to lose the money if the market goes crazy. If you're not aware of this, last week we had a scenario that happened that which was kind of an indicator that a recession may be on its way, just simply because we had the short-term interest rates on bonds exceed the long-term interest rates on bonds. And that's usually an indicator that we could be heading for some slower times, although the market is still still growing right now and everything seems to be working at this point. But you just want to be aware that there are some indicators out there that say that a slowdown may be ahead. So what is an annuity? How does an annuity work, and what is it? Well, I put this up there last week or last month, and it is basically a structured insurance product. It's regulated by each state. So if you have a fixed annuity, and primarily that's what I'm going to be talking about today is fixed annuities or fixed indexed annuities. I'll talk and touch on the variable annuities. I don't typically recommend the variable annuities just simply because those are the ones that have the larger fees, and I'll get into that here in just a second. But that the state regulates these products so that if you are buying a fixed annuity or a fixed indexed annuity, typically your home state is regulating that, and you do get some protection from that as well, to make sure that if something happens to the insurer, that you do have some protection from the state. Now, it's not FDIC insured. A lot of people will ask, are these products FDIC insured? And they're not. But a lot of times, like I said, you do get protection from your state. So you can check with your state Department of Financial Institutions, and they can tell you all about that. But how does it, or what is it actually? So one of the things I wanted to do is kind of compare this with life insurance. So life insurance is a contract between an insurer and the policyholder that pays a death benefit upon your death. In other words, if you die too soon, a life insurance policy will help your family out. Well, an annuity is kind of the opposite of that, because an annuity will actually provide you money if you live too long. And that's one of the things that, as we're building out retirement income plans, since pensions have kind of disappeared and more pensions are kind of going into default, we have to look at a way to guarantee that income possibly over the next 25 or 30 years of our retirement. So a lot of people are warming up to this idea of these annuities. But the reason I'm doing this webinar today, I want you all to be aware of some of the gotchas that are out there, and make sure that you don't get caught by one of those, or you don't go into a situation where you're kind of blind on how these products truly work. They do pay a commission to the advisors that's selling them. A lot of people think that it's a large amount, but when you compare that with the money that you pay in fees on your mutual fund portfolio or your managed portfolio over time, it's really not. The advisor is really taking a hit on the fees over a period of time if they're servicing the product over the lifetime of the product like they should be. There are advisors out there that just sell these products strictly for the upfront commission, and then they move on, and sometimes you never hear from them again. And that's the thing that I think that hurts the industry the most, and hurts the reputation of these types of vehicles the most, because people feel like, you know, that somebody just made some money and then moved on, and that's not the right way to do it. But the annuity is something that provides money if you live too long, and I think that's the key that we want to look at. So the first one that I feel like people don't truly understand is that this is a commitment investment. So it's similar to a CD or similar to a bond. You're buying this product for a period of time. So a lot of these products have a 10-year surrender charge. I'll put that example up there on the screen so you can see that. But the thing that I want you to understand is that if you take the product and use it for what it's supposed to be used for, either a safe investment or something to create some income in your retirement, these surrender charges really should never come into play. You really should never have to worry about paying a surrender fee. In fact, most of the annuities that are out there will allow you to take a free withdrawal once per year, anywhere from 7 to 10% of your account value, so that you still have access to the money. You know, CDs don't do that. Bonds don't do that. The challenge is with these, if you take all the money out, say in my example here at year 5, if you take all the money out, you're going to pay a 6% fee. So that's a pretty hefty fee. So you need to understand, as you decide to take a portion of your portfolio, whether it's 10% or 20% or 40% or whatever of your portfolio, and put it into one of these products, that money is set aside to kind of protect you in the future, kind of protect that income base. So if you're using one of these fixed indexed annuities, the value of that account will never go down unless you have a year that you go without making any money and you have a fee that's extracted from it. I'll talk about that here in a second too. But in most cases, these products should never go down in value, so that when you compare that to the stock portfolio or a portion of your portfolio that's still in the stock market, this is going to be safe, and that's protected. But again, if you withdraw this money too early, you could pay a surrender fee, And you need to understand that going in and be comfortable with the idea of, hey, this money is going to be safe. It's going to be set there on its own. Another thing about the surrender charges in most of these annuities, if you become sick, meaning have a chronic illness or a terminal illness, most of the annuity companies will waive that surrender charge, so that if you have that fee and you become ill, then that fee would go away if you needed to take 100% of that money back out of the account. The other thing is that you have to be sure that you understand how these surrender charges respond to your family at your death. So a lot of these surrender charges are waived at death. Most of them, in fact, are waived at death. If you pass away when you own one of these products and there's $100,000 in the account, your family would get every penny of that. But there are a few out there that do continue to charge that surrender charge at death and require you to take this money out over a period of time. So make sure that you ask your advisor that if you're going to put some money in one of these accounts, you want to make sure that if something happens to you, your family's going to have access to this money. So the next major misunderstanding I think that people have is that about 2004, there was this thing called an income benefit that was created and added to these products. And a lot of people, a lot of advisors, and I have to say this, will kind of gloss over the fact of how this benefit actually works. In other words, they may tell you that you're getting a guaranteed rate of 8% per year or a guaranteed rate of 6% per year. When in fact, that's a secondary part of the account. It's what's called the income benefit or the lifetime income rider. And the lifetime income rider basically is a separate calculation that the insurance company keeps up with from the time that you buy the contract. So if you put $100,000 in, you're going to have that $100,000 is going to be growing based on whatever strategy you use, whether it be an S&P 500 strategy or a fixed income strategy or just a fixed rate, just like a CD. It's going to grow based on that, and you get to change that strategy every year. But the income value or the income side of the account is growing at a certain percentage. And the example I've got here on the screen was actually off of one of the products that is used out there quite a bit, has a 6% roll-up. What that means is that income account value is growing at 6% per year, guaranteed for the first 10 years. And as shows on this illustration, for the first 10 years, it's growing at 6%. So that at the end of 10 years or somewhere in between, if you decide you need to turn on income, they're going to look at your account value, and then they're going to look at your income value. Whichever is higher is what they're going to base your payment off of. And these are geared to be higher than what the account value would grow at. So they're going to pay you based off of the income value. So for example, let's say that your account value had grown to $150,000 after depositing $100,000. But your actual income value had grown to $200,000. Well, what they're going to do is they're going to pay you an income every month like you've got $200,000 in your account. So they're basing your check off of that $200,000 amount so that you actually get a higher payment. Now, the way they work is typically if you start that payment series and it starts coming out to you, then that'll pay for the rest of your life. And depending on whether you choose to pay a single or a joint payout, it could pay for the rest of your spouse's life as well. So even if the account value goes to zero, you should still be getting income for that account. And that's why a lot of people are using these as an income plan or a pension replacement, especially if they've lost their pension or never had one. They're using these as a way to do that. But please understand, your account is not growing at 6%. And I think that's where we have people come in here all the time that say that they bought an annuity from a local advisor and that their account is growing at a guarantee of 6% per year. Well, that's just not the case. And when we explain that to them, a lot of times we have to get on the phone with the company and have the company representative explain it to them to make sure that they understand and they believe us that they're not paying that or they're not actually growing at 6%. Their income value is growing at 6%. And as long as they plan on using that for an income payment, that may be okay. But again, I think this is one of the things that people kind of misunderstand about how these products actually work. And you'll see that there's a fee on there on this screen too that kind of shows you what you're paying for that. And I'll talk about those fees here in just a second as well. So the next one is really understanding those fees. And I thought I'd go ahead and bring in the sister product to these types of investments called a variable annuity, because this is where everybody kind of gets or kind of has this misunderstanding, or I guess they have a understanding of the fees, but they just don't know the whole story. What the ones that typically have the higher fees are what's called these variable annuities. Variable annuities are going to have a mortality and expense fee. They're going to have a mutual fund fee because you're actually still investing in mutual funds. And then they could have an optional rider fee that you add on to it. This screen that I just popped on there is actually taken off of a variable annuity that someone had this when they came into our office, and we do an evaluation of the products that they have to let them know what they actually do have. And this one had a base fee of 1.25%. Then it had a rider expense fee of 1.2%. And then the sub-account expenses, or the mutual fund expenses inside the variable annuity, were 0.93%. So when you think about that at adding all that up at 3.38%, if you invest $500,000 in that account, I mean, you could be paying $16,000, $17,000 a year in fees. That's a huge amount of money to give up in a fee for any investment. So you don't really want to kind of pay that kind of fee. Now, what I will say is I've noticed over the last probably, 7 or 8 years that these variable annuities have started reducing their fees. So they're not as egregious as they once were, but they are still on the high level that you want to kind of keep from paying that if you can. If you've got one of these variable annuities in your portfolio now, one of the things that we always do is we want to look at the benefits that you have off of that annuity. So in this case, they have a rider that has one of those income benefits. So that income benefit may have been growing at a certain percentage, just like I just explained a minute ago. And now the account value may either be higher or lower. So we always want to look at that and make sure that it's can still do a good job for you. I say this all the time. I don't believe in throwing the baby out with the bathwater. So if that's a product that's already in your portfolio and you've already spent a bunch of money on it, even though you might still be paying high fees on it, it still could be a very valuable part of your portfolio. So we want to make sure that we use it for what it can be used for. And we have to decide, do we want to keep on paying the 3.38% or not? But, a lot of times if you've had it for a number of years and that income benefit has grown, we're probably going to keep it because we want to make sure that we're not throwing out a good benefit that we could use. Now, when you look at the other side of the table, when you look at the other types of products that are out there, the fixed annuities or fixed indexed annuities, typically you're not paying any kind of a fee on them unless you choose one of these optional riders. Now, there is an opportunity cost on some of these annuities because what you're doing is, especially in the fixed indexed annuity, is you're sharing the growth of that account with the insurance company. And the reason you're doing that, and there's different strategies you can choose each year as to what level you're sharing with the insurance company. But basically what the insurance company is doing is they're taking away the downside risk of the market. And let's say you've allocated your portfolio to a product that has a 5% cap, and the market goes up 10%. Well, you're going to get 5%, and the insurance company is going to get 5%. But on a year that you've got that 5% cap in place, and the market goes down, you're not going to make anything, but you're not going to lose anything, and the insurance company takes the risk. So what they're doing is they're sharing in that opportunity with you. Now, if you add one of these riders on here, I've put up an example of 2 different riders that you can add onto these products. Sometimes you can add what they call a liquidity rider. The liquidity rider, usually after a year or 2 years, in this case was after 3 years, would allow you to take all of your money back out of the annuity without any surrender charges. So you can pull that money back out and take it, go somewhere else. Let's say you put some money in there this year or last year and expecting the market to be kind of crazy, and and the market finally drops and goes all the way back down to like it did in 2008, or hopefully not that bad, but drops to a level that you want to take the money back out and put it back in the stock market and ride back up the hill. If you have one of these liquidity riders on your accounts, you could very well do that, take the money out and maybe put it back at risk and have the ability to grow that money at a faster pace. The other type of rider is that lifetime income rider. And typically you're paying somewhere between, as it says there, 0.95%, maybe 1.1% or 1.2% that you're paying for these types of riders. Now, normally on these fixed annuities and fixed indexed annuities, they don't allow you to put multiple riders on them. Now, I've seen on the variable annuities where you actually can put a death benefit rider on there. You can also put an income rider on there, and that can really add up the cost. Most of the fixed indexed annuity companies will only allow you to choose one or the other. So if you choose the liquidity rider or a death benefit rider or an income rider, you're only going to get one of those riders added to your account. You can't choose all of them. So it's very hard to kind of overprice these. But again, you are kind of giving up some of the opportunity by using these products, but you're doing it to provide safety too. So you got to, again, keep in mind the underlying value of the account and why you're using this account in the first place. The fourth one is the income benefits that don't include the spouse. Now, I got to admit, I see this probably, I don't know, 2 or 3 times a year where somebody will come in with an annuity that they've purchased in the past. And when we do an analysis of the benefits of the account, sometimes we'll find out that it's just for the owner of the account. So let's say Bob and Sally have IRAs, and Bob decides to put his IRA into one of these annuity accounts that has this income benefit on it. And he didn't check in the beginning, but his income benefit is only payable to him for his life. So when he turns it on at, say, age 65 here, you could see that he would get as a single payer, he would get a 4.9% distribution of that account value. But when he passed away, then his spouse would only get the account value paid out to her. He would get the income from it for his life, but the spouse would only get the payout of whatever's left in the account value. A better way to do that, to make sure that you're protecting yourself and your spouse, is to have that joint benefit on there as well. Always ask, if you're getting ready to purchase one of these, or if you're getting ready you put a little bit of money in one of these, make sure that if you've talked about the income rider, how it rolls up, what the percentage is, what you're paying for it, and all that. But also make sure that you ask, if I pass away, does my spouse get to continue this income, or is he or she going to just get the balance of the account? In any case, if you do the joint payout, and both of you pass away, your beneficiaries should get the payout of the account value. So again, if you've got $100,000 invested in the account and it grows to $300,000, and you start taking income out and you pull all the way down to, say, $150,000, and both of you walk out on life, then that $150,000 base that's still in the account value should be paid out to your beneficiaries. And you want to ask that question and make sure that it is. But, this is pretty typical scale here that I've got listed up here. Is it's showing, if you take a single payout, you're going to get 1%. If you take a joint payout, you're going to get a little bit lower percentage. I mean, if you think about it, that's how pensions work. When you choose your pension option at work, typically, if you're going to include your spouse, you're going to get a little bit less payout, or a little bit less of a payout every month to you. So number 4, making sure you understand those income benefits and making sure that you include your spouse if that's part of your overall plan. And then the 5th one I just put up here today is I want to make sure that you understand that these products are not designed to make stock market returns, especially the index products. The index products are really designed to, as I said in the beginning, kind of give you a safety net or a slow growth type portfolio. This chart actually was measured from 2007 to 2012, so just a short time frame, but it shows indexed annuities averaging about 3.27%. I've been working with these products since the late 90s, and I've actually owned several of them, but the one I've owned the longest is I bought in 2004, and it's averaged right at about 5% over the time that I've had it. So it's a slow grower. It's not something to write home about. It's not something to be, really thrilled about, but it's part of your portfolio that's going to, provide you that slow growth and that protection that we talked about. You're not going to get the high value returns on that unless you have a market like a 2008 when the market goes down, and you kind of get to recap that when it comes back up on the other side. So let's look at this. So this was actually, of course, these products, especially the fixed indexed annuities, only came out, I think it was around 1998 or something like that, maybe 97. But if you'd had one of these during the Great Depression years of 1929 or 28 through 1952, this is how they would have responded. With a 50% participation rate in the S&P 500, you can see that when the market went down, the red line there, you're not making anything, but you're not losing anything. But when the market ticks back up a little bit, you can see that you would have made a little bit of a gain there. So you would have protected your money during that Great Depression period of time. Of course, we didn't have them back then. The oil crisis of the early 70s and the early 70s through the 80s was about an 8-year period of time. Again, they didn't exist during this period of time. But if you had one of the indexed annuities, that's how they would have performed. And this is actually how they did perform during the Great Recession of 1999 through 2013, is with a 50% participation rate. You basically avoided those two big valleys there that happened in 2001 and 2, and then 2008. You were able to avoid those valleys with your safe money, and then recovered nicely on the other side of those. So you were able to pick up a nice little bit of return on those. And again, I think that this is not necessarily for everybody, but it is a product that can be added to your portfolio if you're trying to protect some of it in retirement. Gives you a great way to do that. And, hopefully that gives you some insight on how these indexed annuities and, some of the variable annuities things work as well. If you'd like to ask some questions now, you're welcome to raise your hand, ask some questions. We'll be happy to try to see if I can answer some of them. But what we're trying to do with these webinars is really provide you more information, more of an education, something that you can, sink your teeth into and make the decisions that you need to make going into retirement. We only get one shot at this. We get one shot at making a good retirement plan. And I want to make sure that you have enough information so that if one of these products look good to you or something appears appealing to you, certainly check it out. Make sure that you are talking about it with your advisor. If you don't have an advisor, obviously, one of the things we do is we help people build retirement plans, and we'd be happy to help you all do that as well. We'll see if I got this. Okay, I got one question here that basically says, how much do you need to invest in an annuity? Well, basically, every insurance company is going to be different. Most of them are going to be around $25,000 to put into one of these products. Some of them start out as low as $10,000. So it just depends on what you're looking at. You also want to make sure that you're not putting everything into these products. I think that, in the past, you've been able to put more and more into them, but I do think that you can have a little bit of at-risk money too. Now, even saying that, I'm thinking of a couple of clients that just really didn't want any at-risk money, so that they have put a lion's share of their portfolio into these types of products. But everybody's different. You have to make sure it's appropriate for you. But usually, like I said, 10 to 25,000 is what you're typically going to need into these products. If I die, what happens to the balance of my annuity? Will the insurance company keep the money? This is another one of those misconceptions. The old annuities that came out years and years ago were basically the pension plans. So essentially, if you've got a pension plan right now working for somebody and you choose a joint survivorship benefit and both of you pass away, the company keeps the money. That's how the old annuities used to work. there's very few of them out there now that do that. I mean, most of them are that balance in whatever the account is, or whatever that account value is at your death, will go on to your beneficiaries. But that's a good question. You want to make sure that you ask that when you're sitting down with somebody and looking at these products as possibly an option for you. You want to make sure that you ask that because, like I said, there's not very many of them, but there might be a couple of them out there that still direct that money back to the insurance company. And I guess the other thing to understand there is when you annuitize one of these accounts, there's different ways to take money out of it. So those are the things that you want to be careful of, is how you're actually setting up that money. A couple more questions and then I'll start to wrap it up. Do you have a recommended portfolio percentage to put in annuities? Not really. I mean, it just depends on what you're starting with. Normally when we sit down with somebody, you're going to probably put somewhere between, 25 to maybe 40% of your portfolio in some kind of a protected product. It may not always be annuities. It may be a bond portfolio or a laddered CD portfolio or something like that. But you want to have, as you start to look at retirement, you do want to shift over to that protection mode, because you're looking to try to increase this or make this money last possibly for the next 25 or 30 years. And one more here. How do I know if they're right for me? The only way that you really know if they're right for you is to go through a process. Go through a planning process with somebody that is a true financial planner that's actually going to look at your current portfolio, understand where you are, what you're trying to accomplish in your retirement years, and then put a plan together for you. I think that's one of the disservices that a lot of financial advisors do out there, is that the first thing they'll start talking to you about is some kind of a product. It may not be an annuity. It might be a real estate investment trust, or a bond portfolio, or a managed portfolio, or an annuity. And really, they don't know what's going to benefit you until they run an analysis of your current situation and what you're wanting to do. And if they haven't done that, or if they haven't started talking to you about that, if they just come at you with a product, those are the types of people I usually thank them for their time and get out of the office as quickly as possible, because I don't want to just buy a product. I want to have a plan for the next 25 or 30 years. So I really appreciate everybody being on the webinar this morning. If you'd like to go back to and see some of our other webinars, like I said, you can go to mwawebinar.com, and we've got our other webinars posted there. Look forward to talking with everybody again. We'll probably have another one coming up next month. So stay tuned and watch your email, and we'll continue to pass these out to you. Thank you all very much.